So,
so we do a weekly Bitcoin show because there's just so much news in Bitcoin. And one of the things someone asked yesterday was, how is the market different today than it was in 18? And the answer I gave, which I'd be curious to your reaction and tie it back to this, is in 18, it seemed like everyone was speculating. People, right, were buying Bitcoin to sell it at another price to make money to go buy stuff with, right? This sort of idea of hodling or being like an investor, I think really hadn't taken hold. And I can tell you as an institutional investor, we own, $600 million or so of Bitcoin. We're investors, right? We haven't sold any Bitcoin, right? We deal with the ups and downs. But it does seem that there's still and I don't know what percentage of the market, right, is composed of speculators, right? And price action tends to be driven by the marginal buyer or seller. I guess I just like your reaction to the market composition today versus what it used to be. And, again, is it speculators that are driving the market, or is it this institutional adoption that we're seeing?
Yeah, the market's completely different from 2018. 2018 was a bear market, right? So that's.
I'm sorry. So 2017. I mean, when I say that.
2017 was, Bitcoin had a lot of exchange activity, but very little of it was levered. We didn't have well-developed futures markets. The leverage you could get was on margin, so borrowing rather than derivatives. And so the price was more, less, I would say it's less levered. But I'd say also right now, we've got this very large dominant derivatives market, I'm just looking here. The normally derivatives market was much higher than spot, sometimes 5 to 10 times higher. We've just flushed out a lot of the derivative traders. So even now, post that flush, the derivative volume is 50% higher than what we're seeing on spot volume. I would say, you might think that the derivative market has a lot of price control over Bitcoin, but actually that's not entirely true. It has a very short-term dominance, because if you're going to buy Bitcoin on margin, or you're there for whatever you buy, you're going to have to sell out sooner or later because it's a short-term trade. And so ultimately, what's really important in this market is the long-term investors who are coming in to buy and hold. Whether they're coming in to buy and accumulate, or whether they're selling, ultimately, when we're looking into the weeks and months ahead, that's going to determine the price of Bitcoin. Essentially, the demand and supply that's dominated by the long-term investors. And this is what we're looking at on-chain. We can't actually see what's happening so much in terms of the trade positions on-chain. We can't see any of that. You have to look at data coming off the exchanges. But whatever happens in the short term, even if traders are shorting, and when you see long-term investors coming in to buy and accumulate, you'll know that it's going to be the traders that are going to get wrecked. They cannot continue to short and sell off into this demand that's coming from long-term investors.
So you raise an interesting point. There's a lot of discussion that the influx of institutional capital is going to reduce the volatility of Bitcoin. I actually don't happen to share that view, which seems to be consensus. And I hadn't really thought about what you just said, which is that we have much more leverage in the system today than we did in 17. So that makes me feel more strongly that, we're a ways away before Bitcoin becomes a less volatile asset. What's your view on that?
Yeah, I've run a projection on volatility. I've got the volatility of Bitcoin since the markets first opened in 2009. And if you plot that on a logarithmic scale, where originally the volatility was over 100% over a 60-day period, it is coming down. It is coming down. It's a decay. There's kind of like a half-life of decay, and most people will not notice it because they're only looking in the last few months or the last year. But if you plot this over the long-term scale, we're looking, I can't remember offhand, I think it's about in a decade, give it another dozen years. It's actually on track to cross under the peak volatility of USD Euro, which is quite surprising. But that's what happens when you map this over the long term. This asset class is still very, very much in its infancy. It's taken us 12 years to get to somewhere between 2 and 2.5% of the world population having exposure to it. We've just broken $1 trillion of capitalization. It's set to get a lot bigger, and as we get that kind of scale into the system and that kind of capital, it will reduce in volatility, and we have seen that for 12 years. I've been seeing the volatility over the last, say, 3 years reduce as well. Now, the reason for that is that I think very strongly, like in 2018, we had very high volatility because all of the leverage was essentially one exchange that was unregulated called BitMEX. And there was a lot of if you've been trading that market, you could see a lot of, maybe you call it trader games, where, these stop positions, the defensive lines where people would exit their positions, they were being hunted through essentially, you could either call it manipulation or you could call it game theoretic trading, where you're pushing the price in a particular direction to take out traders. That was very evident. I used to say the short-term price action of Bitcoin was essentially a random walk to liquidate the most traders on BitMEX. And obviously in that kind of era, you would see this ridiculous amount of volatility where you have these wicks of price going, up, whatever it was, hundreds of dollars in minutes, and then it would revert back down as traders were being liquidated. And the price action was it's like a square wave, like these bats that would go up, down, and very choppy. And now we're in this era where, you've got like 20 derivative exchanges, and most of them are playing very nicely. BitMEX, now a very much minority of it. You've got the CME, which is wholly regulated. And so there's less volatility just in the sheer mechanics of the industry, the infrastructure there for trading these derivatives. And then when you add to that this kind of 2021 year, tail end of 2020, where we've had very, very large spot demand coming in from institutions, it's limiting the downside sell-off from what you'd normally expect from derivatives. So I keep in mind this kind of idea where you've got an organic price of Bitcoin supported by spot investors,